Well, look, I think when it comes to policymakers, particularly the Fed, look, they're forecasters. They set policy. They also have a role to promote confidence in the economy too. It's not a criticism. That's what they need to do. They're public officials. So look, I'm not quite as upbeat that the growth downturn will be that shallow. This has been an enormous hiking cycle. It doesn't look like it's all that close to peaking, certainly compared to where we sat a few months ago. And the idea you can get some kind of immaculate disinflation, everything can kind of adjust. There's not really any precedent for that. I think the recession is going to be worse. I'm not criticising her view because she has to promote confidence in the economy. But it does worry me a little bit if the markets were to get too complacent, as they probably were a couple of months ago, that this could all be relatively painless. Inflation isn't going away. It looks worse than where we were a few months ago for the US, for Europe, for other places. And surely central banks have to do more and cause more pain to get that disinflation, to get this sticky inflation out of the system.
Boy, Tim, I mean, there's a strong argument to be made that the markets have gotten a lot more, or less rather, complacent just over the last couple of weeks. And I want to throw up treasuries. Let's take a look at yields. Last time I checked, the long end, we're, 5-6 basis points away from 20s and also 30s hitting the four handle, which would mean the entire curve has a four handle on it. That's one. And two, if I'm not mistaken, there you go. The long bond has finally flipped. So we have the entire yield curve, 2 years out to 30 years, absolutely perfectly inverted. That doesn't look complacent to me.
No, it's not. It's just that we were pretty complacent, I think, at the start of the year. As you say, we've shifted a lot ever since the non-farm payrolls, services, ISM were stronger. So I think that complacency's come out. But I just think like this recent price action could extend. We had the US core PCE out on Friday. What we thought was a 3-month core inflation pulse of roughly 3% in December, with upward revisions with the January print. Now we're looking at not 3% on a 3-month annualized basis, but more like 4.5%. So the direction of traffic is more worrying. And as you say, look, less complacency in the market than a few weeks ago, sure. But I think the trend is still towards even less complacency, even more realism that this is going to be a harder fight. My economists in New York recently upgraded their Fed view. They think they'll get to 5.6%. I think that's around top of the market now. So it's just, that's the general trend. We're moving more away from the optimism at the start of the year. I think that makes sense because it's all well and good for inflation to peak, but when it peaks at double or triple what the targets are for these central banks, it takes a long time to come back down. It's not this kind of V-shaped kind of story you've had in previous episodes. It's great that the rate of change has slowed and then we're turning the other way. It's just going to be a longer path, which ultimately I think leads to a recession by the end of the year.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.